With the commodities crush literally digging into its bottom line and currency headwinds pushing back on profit margins, Caterpillar's fourth quarter loss and lighter than expected sales figures were hardly a surprise. From the company's point of view, it's adapting to changes in the global economy, cutting costs, and its outlook, hardly rosy, is perhaps not as bad as some had feared.
16 is going to be rough and challenging again, I think, and given all the things going on around us, but I'm very happy with our performance in 15.
The costs of change, restructuring, are what some accountants will tell you to ignore. In Cat's case, ignore those costs and earnings actually beat expectations. It is still spending on things like R&D, digital applications to mine for the kind of data that can help the buyers of Cat's heavy machinery save money in the future. That's the kind of positioning analysts will parse carefully.
I think there was a sigh of relief more than anything going into 16.
In China, for instance, Cat sees growth, even if it's less growth than before.
I think there's an overhang of lots of things, and from commodities to you name it. But it will work out. They're still growing at 6 to 7% a year.
But the slowdown in China includes a drastic decline in construction, lower demand for commodities, coal, iron ore, and oil, and lower prices for Caterpillar's heavy machinery. Caterpillar's total sales peaked at almost $66 billion in 2012, but are expected to fall to $42 billion in 2016. Weak sales in Brazil aren't helping either. If Cat is seen as a proxy for the global economy, then we may be in the roughest patch we've seen in at least 5 years.
I have no overweight ratings in my sector, so I'm not recommending that investors buy into machinery stocks at this point, and that's a first for me through the course of my career. This is a unique period of time for investors, particularly in cyclical stocks.